Good morning, everybody, and welcome to the Newton Institute. I'm David Wallace. I'm the director of the Institute, and I'm really pleased to be able to join you this morning. In fact, this might be a welcome back for some of you, because there was, a few years ago, there was a quantitative finance program run at the Institute, and either you or perhaps your colleagues might have participated in that. I don't want to take up much of your time, I know you want to get on with the talks, but maybe if for those of you who don't know anything about the Newton Institute, here's sort of 1 minute on it. It's actually a national facility in the mathematical sciences. We run long-term research programs, 1 to 6 months, which attract the best researchers from across the world. Mathematical science is broadly defined, so pure maths and all ranges of applications from astronomy to zoology, with a lot of things in between. So it's a really fun place to be. This particular program is in stochastic analysis of high-dimensional data, running for the first 6 months of this year. I'm really grateful to the organizers for the work that they put into putting the program together, and particularly to Chris Rogers, I think, who's helped to initiate and pull the program together for this morning. Thank you all very much for coming. I hope you have a really great time here. I think the best thing about the Institute is just the informal interaction. The way I like to think of it for academics is that this is the place where when you come, you realize this is why you became an academic. But it's fantastic, actually, that whenever we have the opportunity to reach out to end users, as many of you are, then we really like to do that. And it's good for our funder as well, the Engineering and Physical Sciences Research Council. And I will finish simply by saying that in order to prove that we reach out to end users, I'm thinking of taking a photograph out in the car park, because it doesn't normally look like that. Anyway, I'll certainly be joining you for the first half. So I think over to you, to Mike Pickering, who's the principal organizer for the program. He's going to chair the session this morning. Thank you.
Well, thank you, David. I'd like to add my welcome to you to the Newton Institute. As David said, I'm the principal organizer of one of the 2 research programs that are taking place during the first half of this year. And we've had a lot of organizing to do, but as far as this meeting is concerned, we've had almost nothing to do, because it's Chris Rogers that has very generously given his time to set the meeting up and to invite the speakers, and we're just very grateful to him for everything that he's done. Anyway, I shall act as chairman for the talks, and therefore my next task is to pass over to Dr. Ewan Kirk of Capital Partnerships for the first talk.
Right, well, Chris asked me to talk at this set of seminars, and I did feel a little bit sort of overwhelmed by talking to all of these smart academics and some practitioners. I didn't really know quite what to talk about. So what I thought I'd do is, rather than talking about any interesting research or interesting solutions to problems, I thought I'd just talk about the problem, because there is a really big problem with high-frequency data that people don't normally look at and don't understand the scale of the problem, and how, at least in my view, is very different from classical financial modeling. So what I'm going to do is I'm going to go through some data and sort of focus down from the large timescales all the way down to the micro timescales, just to show you the types of problems that you're going to have to deal with in this data. Now, I've used futures data because there's so much of it. I mean, there's an incredibly large amount of futures data, much more than there is, say, from the foreign exchange market, and certainly much more than you get from the stock market. But I would expect that the type of modeling approaches that you would want to think to develop would be similar across all of these markets. So let me see if I can work this. Okay, so we produce, in the financial industry, we produce a massive amount of data every day. probably the only thing that is even close are high-energy physics experiments, which do produce massive amounts of data as well. The financial industry produces a huge amount of data. And most of it we throw away. We smooth the data, we sample the data, we throw away all of the information that was all there, was produced every millisecond or every second. We throw most of it away, both the practitioners and you as researchers. But, of course, back in the old days when we had steam-powered computers, we had to throw it away because we couldn't deal with it. Maybe now we have the technology to be able to do it. Now, the problem is that all of our professional lives, we kind of assume that markets are log normal with a drift. Now, maybe we start looking at things like fat tails, or we do power laws, but basically we're kind of assuming that it's Gaussian, and we always assume that it's Gaussian or near Gaussian. And for high frequency data, that's just not true. And it requires a really big mind shift to understand that things like return and volatility are just not the sorts of concepts that you can use to apply to this. Now, given that you've spent all of this time learning all of these concepts, it's a little bit of a shift, okay? Now, huge amounts of data, 200 megabytes of data per contract per day, and there's maybe 1,000 futures contracts. Okay, that's a lot of data. It's just getting it in and out of a computer isn't easy, okay? Now, when you look at a single contract, it doesn't come at regular spaced intervals. It's bursty. It's not evenly spaced. You get 5 ticks in 20 milliseconds and then nothing for 10 minutes. So how do you deal with that kind of problem? How do you deal with things that are not evenly spaced? And then, when you get to the really hard problem, you start looking at multivariate. Many futures contracts. Think about the DAX and the FTSE, or the DAX and the Eurostoxx. They're kind of related. They're sort of the same thing, nearly, but not. But you can't correlate them because nothing's happening at the same time. There's ticks coming in here, then there's 20 ticks there, and then there's 1 tick here. How do you think about many things operating at the same time? And there's lots of approximations that we use all the time as practitioners. We form bars, we sample data on second intervals or hourly intervals. But that's just throwing away lots of rich structure, which might be interesting. And I would have thought, as statisticians, you would be interested in that rich structure, presumably. Okay, now the final thing, and of course the reason why I'm here, is the financial opportunities in this are very large. If you can get it right, then potentially you can make a lot of money. And from my side of things, that's really important. So, okay, right? I like the bits about making lots of money. And if any of you have any ideas on how to make lots of money, please see me afterwards. Okay, right, so let's descend into the data. Here is probably the most famous wiggly line in finance. This is the S&P 500 spot index. And I've put 20 years of data up there just because, well, who cares what happened before the 80s, right? I mean, there's 20 years of data. You do your eyeball statistics on it and it looks a bit log normally plus a drift, right? Everyone agrees with that. I mean, and it does look a bit like that. This sort of, people have spent 20 years looking at this data. I would say that probably 50% of all financial papers probably use this data at some point. There's only 5,000 data points here. There's not enough to really do anything with. However, what does this mean? What is the S&P? I've seen lots of papers where people say we use the S&P or the Lehman Bond Index or the price of oil. Well, what is that? What is this number? What is every point on this graph? Does it bear a resemblance to what happened during the day? Does anybody know? How does the close get formed? Does it change? Has it changed now that we've got 24-hour trading markets? What does the close of the S&P mean? All of these questions are things that you have to ask about the data once you start looking at it a little bit more closely. So let's look at it a little bit more closely. Okay, here's a month worth of data. Well, month worth of daily data. Now, as statisticians, you're going, "Pooh, that's 20 data points, not much I can do with that." And indeed, there isn't really very much you can do with that. But there's lots of interesting things going on here which we've just ignored. Okay, there's weekends in here. What would you like to do about a weekend? How much volatility is there over a weekend? When you look at this 20 years of daily data, you just say it's evenly spaced. But if the markets are moved by news, then what about news over the weekend? Does that count? Should a day be 3 days of volatility or 1 day of volatility over the weekend? Again, all of these things you kind of ignore, and it's fair enough to ignore them because there's lots of rich structure when you ignore it. But once you start getting a little bit closer into data, you really need to take care of it. And also, there's also that day there and that day there where the market was only open for half of the day. So should we give exactly the same amount of weight to that or not? I don't know. There's holidays as well. What about January the 1st? There's no data there at all. Okay, so lots of interesting data there, but we're sort of losing a lot because we're zooming in on it. So we could use more frequent data because the S&P close is only published once. So what about futures data? Because the futures markets trade nearly, although not entirely, 24 hours a day. So here's the E-mini, which is the day trader's contract of choice. The E-mini futures contract is not the S&P contract. It's different. Pop quiz, why is it different?
Dollar value of each point of that.
Nope. Well, this is the first nearby in it's first nearby for the March delivery. So this is the expected value of the S&P contract on the 18th of March, which includes the value of dividends and the time value of money. So it's not really the S&P, is it? And presumably, as Mr. Bernanke has cut interest rates, this differential will have changed. So there's all of that kind of problem. Now, let's think of another problem with the futures data. What happens when a futures contract rolls over? Goes from one contract to the next contract? Well, you've got to join those two series together, but you've got to do percentage adjustments on those series. It all gets really messy. But there's lots of advantages in the futures data, so we'll ignore all of those issues, but bear it in mind that you have to deal with these issues. There's also liquidity issues. I'll do one more. There's quarterly contracts on the S&P, and they trade up to, but not exactly to expiry, and then liquidity moves from the first nearby contract to the second nearby contract. In some markets, that's 2 days before expiry. In some markets, it's a month before expiry. So how are you going to decide how to splice all of this data together? There are lots of really difficult issues there. Lots of heuristics on how to do that, and practitioners do it all the time, but maybe there's a better way. So let's just ignore all of that, and let's start looking at hourly data. So, whoop, there's hourly data on the S&P. That doesn't look very easy to deal with, does it? Something's going wrong there. Sorry, we'll go back. This stuff down here is our plot tool system. This is the symbol. So it's a CCP, RT, E-mini, H, which is March 2008, traded price 1. And that's hourly bars, so 60-minute bars. So one of the problems with all of this data is sometimes there isn't any. So when the market closes, for example, sometimes the exchange just publishes zeros. Why do they do that? I've no idea. But they do, and that makes things really irritating and annoying. So what you have to do is get rid of the zeros. And now we've got rid of the zeros with this fabulous function here, zapz. You can tell that I used to work for an American investment bank. I say things like leverage and Z all the time, and I do also say beta rather than beta. Okay, so we've cleaned up this hourly data, right? So now now remember this is just 20 days worth of data. Well, depending on how we define days, of course. So that's from 1st of December through to about the 14th. Unfortunately, I did this presentation before Jérôme Kerviel did his stuff, and then I could have said some interesting things about that too, because that's really some interesting data, but I couldn't be bothered to update the presentation. Okay, so this is now hourly data. Now, embedded in that little phrase, hourly data, are an awful lot of sins. Like, what is hourly data? I mean, is it on the first, is it the first tick of the first hour? Is it the average price over the hour? Ugh, you don't want to do things like that. Is it the high, the low? Is it the close? How do I know at which point I've got this hourly data? And how do I define an hour? Is it GMT? Is it New York time? I don't really know. And also, there's lots of really funny stuff going on here. I mean, that doesn't look very right, does it? Or that. I mean, that's obviously holidays. So I'm going to have to do something about holidays. But if I snip the holidays out, then I'm going to get these big jumps. But they didn't really happen, or did they? Lots of, again, interesting stuff here. The S&P is, apart from the fact that the S&P is kind of what people think about as a stock market, even though it isn't, it's a very interesting contract because it has bursts of liquidity from approximately 2 o'clock in the afternoon or 1 o'clock in the afternoon our time through to about 7 o'clock in the afternoon our time, because that's when Americans are awake and trading. So not all of this data is as good as other bits of data. There's also some very interesting spikes there. So this, now, you know, we all know that the eyeball is not a very good statistical device, but that doesn't look really like log normal plus drift to me. But it's going to get worse. Oh, and I'll just point out there's 680 data points in that hour. So we'll do a little bit of maths. So about 4 months worth of data on an hourly basis is equivalent to all the data you've ever looked at on daily data on the S&P. And we produce a new 4 months of data every 4 months. That's good. Okay, so let's zoom in a little bit more, right? So now we're getting right down to a single day. Now, I just point out I chose the 15th of January at random. And the reason I chose the 15th of January was I wrote this presentation on the 16th of January. I could have chosen any day. So I've just chosen this one. Right, so there's a lot more information here. So I've overlaid here the hourly, which is the blue line, 15-minute bars, which are sort of the reddish color, and then the puce color is minutely data. So this is starting to look a lot more interesting, a lot of information here, okay? So there is there are 1,387 minutely points, which means that 4 days worth of data is more than the entire S&P graph. So you've got more data to play with. And as statisticians, I thought you liked data. Okay, I thought this was the thing that sort of lit your fire. So isn't this interesting that every 4 days I'm producing, or the markets are producing, for one contract, more information than all of that daily data you've been looking at for most of your careers. So I think we're sort of starting to get to something quite interesting here. There are, of course, times here, like here, there's not really very much going on there, is there? This is probably, well, this is in Eastern Standard Time, so this is kind of the New York evening. This is the bit during which everybody was awake. This is kind of when London was awake but nobody else was, and this is the early morning New York time. It does seem as if not much is happening, but this is just because I chose this day at random. Sometimes it's sort of not much happens during the New York day and lots of things happen during the Asian day. That's just the way it is. Just in case anybody still thinks that you can use Gaussian statistics on this, the kurtosis of this data is 45. Right? So it doesn't look as if simple normal is going to work very well, and I might as well sort of destroy the ending story. It's going to get a lot worse than this. Oh, and the other thing, which I should say here, I've still thrown away 99.5% of all of the data produced that day. Okay, so there's more. So let's go and look for more things. All right, this is tick data. Okay, people who get excited about trading, and that isn't me, look at these screens all day, and this is what they see. Okay, so what happens? Let's think about what's actually going on in a futures exchange. Basically, the futures exchange electronically sends out a message to a subscriber to a particular RIC or contract every time something happens. And what we get, or the types of information we can get, is a trade happened, and there's a price at which the trade happened. We get the size of the trade. How many lots were traded? Okay? And obviously, well, we get the price. We also get the time, but then there's lags. You've got to start thinking about, is it the time that I received the update, or is it the time that it was stamped by the exchange? Sometimes the exchange stamps trades and then sends them out. Sometimes it sends them out and sends out a trade time afterwards. That all gets really messy, and that's probably not something that you want to worry about at the moment. It also sends out the best bid and the best offer. And it does that every time it changes. And then there's more information which we'll go into down here, which is the level data. Now, this is just one contract. There's thousands of these contracts, and this is just this contract at this particular time. So let's just look at this screen so that you get an idea of what's going on. Okay, so the last trade was 13.79 and a quarter. Okay, it was a down tick, so it was down from the last trade. And as of this minute, there are 35 contracts on the bid at a quarter. There's 96 contracts on the offer at a half. And then behind them, there's another 5 levels of data, where at 79 flat, there's 116 contracts on the bid, and at 75, there's 207 contracts on the offer. Now, these numbers here flash continuously all day as people put in bids and put in offers. So not everything is a trade. In fact, as we will see, most of the information is in the changes here as opposed to the changes here. Some of the bond futures contracts, for example, there are literally thousands of contracts there, and this thing is changing every 10 milliseconds, but there's not very much trading going on. So trading is not necessarily all of the information. Even though you think about a traded price as giving you some piece of information, what's going on in here, the market depth, is really the majority of the information. These numbers change far, far more frequently than you actually have a trade. Okay? So that's the GUI view of what's going on, but of course we get sort of fixed messages and exchange messages that send you all of this information, but it's a continuous high-frequency data stream. Okay, so rather than doing this barring process, which when I showed this data here, which was minutely and hourly, what I had done is I did what most practitioners do, where you take all of the data and you turn it into what's called a bar, and it's drawn on a graph as a vertical line with a bid, with a open, a close, a high, and a low. And so you batch up a minute's worth of data and you output a tuple containing 4 numbers, one of which is the open, one of which is the close, one of which is the high price achieved in that minute or 15-minute or hour, and one is the low price. Now, there's a lot of potential problems in there, because it's clear that for example, I don't know what the high in that 1 minute period is until that minute period has ended. I know what the open is, but I don't know at which point I knew what the open was, which is the first tick in the bar. And also, I might be weighting things incorrectly. I might just happen to sample at the end of the minute when there's one bad tick, and I've got a higher price there than I expected it to be, but all of the other prices were low. So I'm really throwing away a lot of information, which I'd rather not, because I've got all the tick information. So here's tick data. This is exactly the same. I've got here the traded price, the bid, and the ask, the offer. Now, obviously, the traded price is always between the bid and the ask is always above the bid. Okay, so you always have to check that. Sometimes it's not, but then you don't get to make any money out of that because it's just a mistake from the exchange, which happens a lot as well. Okay, So let's zoom into 30 minutes worth of data. So we're zooming into every tick means, in this case, every single change that happens. So there's more information here than you can fit on the screen. So there's a little bit of sort of smushing up of the data. So here's my random 30-minute window from 10:30 EST to 11 o'clock EST on the 15th of January. So it corresponds to about 3:30 to 4 o'clock London time. That is when everyone's playing the game at that point. Massive liquidity, everyone wants to trade at that point. So this doesn't look like Gaussian data, does it? It's all sort of digital and bursty and not very easy to deal with. Oh, and there's, and as I say here, there's 1,400 trades in that 30-minute period and 43,488 changes of the bids and offers in a 30-minute period. Now we're really talking about lots and lots and lots of data. And every 30 minutes you get more of this stuff. So you should be able to do some quite good statistical modeling on it. So in a single half an hour, okay, there is more data than the entire history of the S&P. Now, I would have thought, once again, that would be quite exciting, be something that you might want to deal with. Okay, so we're going to zoom in again. Here's 2 minutes of data. All right, so what have we got here? Well, it's a bit confused, but the blue blobs are the trades. The green line is the bids. The sort of puce-colored line is the offer. The red line bopping along the bottom here is the traded volume, and the bid size is this sort of purpley line, and the ask size is a sort of cyan line. Now, what can you tell from this data? Well, firstly, this is not a Gaussian process. Anybody think it is? No. Okay. Interesting stuff, I suppose, is that the traded volume is always very much less than the bid volume and the offer volume. So there is quite a lot of information in this market. And remember, I've let you off quite easily here because I've only put on the first level of bid and the first level of offer. There's another 8 numbers here that we want to stack up to make a bid and offer stack. Let's zoom in again. Here we are, 10 seconds worth of data. Right, so 10 seconds worth of data. Now there's some real structure here. Okay, we can see what's going on. We can see this. So now we can start to see the bursty nature that I was talking about. So here's a period of about a second where nothing. We'll in the first second there looks as if there's about 10 trades there. Most of them on the bid, but 1 on the offer. So more trades on the bid, and then a quick pop down, and then nothing happens for a second or so. And then we have another pop up and down. Meanwhile, the bid and offer sizes are changing. And the traded volume, you'd expect a number in the traded volume to correspond to a trade, which indeed it does. And then, well, we'll start to think about things here. If this was a trade on the bid, then this drop here makes sense. Okay, because we traded what looks like 40 lots, maybe 40 lots on the bid, and the size on the bid went down by 40 lots. Okay, so there is some structure and coherence to this data, but that's not always true. But maybe there's some information in the fact that here the offer size is going down and down and down, even though most of the trades are happening on the bid. What does that mean? Does that mean people are pulling their offers? I don't know. Okay, here's 1 second of data. There's an awful lot of data on this, and this is just 1 second, and every second this data is being produced. So we have lots of interesting artifacts here. Here's a simultaneous trade at the bid and the offer. How could that happen? Well, I don't know. Remember, I've just chosen this at random. I mean, I literally just zoomed in on a bit of data and said, I wonder what I can see here. So how could a trade happen at the same time the bid and the offer? If you're doing some modeling of this data, how are you going to handle things like that? I don't know. I mean, if I knew the answer, I wouldn't be here. Here's some little changes on the sizes. Very interesting trade here that there was a trade on the bid, but the bid size went up massively. So it's not a question that if you trade on the bid, then the number of people who are on the bid goes down, because maybe at almost exactly the same time, people put in more bids to take advantage of that. This could be one of these things like an iceberg order, which I'll come to in a second. So there's lots of interesting structure here, but there's also lots of artifacts, which if you're going to try and model this, you have to have some way of filtering out these artifacts, but without filtering out the interesting information. Okay, so we've got 1 second. Okay, there's that 1 second in tabular format. I formatted this in Excel, and because Excel's so brain damaged, it doesn't understand the fact that there can be times less than a second. You can see that, well, here's some interesting things. There's lots of holes in the data, because I had changes here on the bid size and the offer size. So I got a message here. Nothing changed on the bid and the offer, but there was no trade message. How are you going to handle that kind of thing? What are you going to do in that period? Do you know what the price could have been? And then let's make life even more complicated. Here's 4 futures contracts, 1 minute worth of data in equities land, and to make life easier, I've removed all of the bids and offers, because that just complicates matters even more. But don't forget, it's there. So we've got here, there's the S&P, and there's the FTSE, and the DAX is the green one, and the CAC is the sort of puce-coloured one, and that horrible green colour is the Eurostoxx. Now, to make this work, of course, I've normalized this data so that it started at 0. So this is just a sequence of +1s and -1s that are changing the data around. But you can see here that it does seem as if over this 1 minute period there was a little rise and a little fall. Now, the Eurostoxx hasn't gone up very much, but the DAX has gone up quite a lot, and the FTSE's gone up even more. Now, why is that? Well, that's actually because the notional value, or the index level for the stocks, is 1,500, and the index level for the DAX is 8,000, or, well, it's probably less by now. So you can't, it's not really clear that one tick here, a move from 2 to 2.5, is exactly equivalent for every futures contract. So once you start moving to more than one futures contract, you've got lots of issues to deal with there as well. If the true fair price, if we were omnipotent and we could look at the true fair price of the Eurostoxx 50 and the CAC, well, if we knew that the Eurostoxx 50 was right between 2 ticks, so it was 1350 and 1350 and a quarter, so it was actually 1350.125, maybe the movements in the CAC tell you something about that, because it's it's got more discrimination, it's got more resolution in terms of the movements. But then the CAC isn't exactly the Eurostoxx, it's kind of close, but it's not exactly the same. It's not really clear that you can use your old correlation of returns analysis on this. I mean, I'm not sure that this is really, that's, well, certainly the way that we would look at things, I'm not really sure that this is a return in any sense. And I'll come back to that, because, of course, the fabulous thing about the futures markets is you can trade all of this for no money up. You don't actually have to put any money up to trade these things, you just trade them. So concepts of return become a little bit woolly. Okay, oh, and let's not forget, we were just looking at the futures markets. Here's the oil markets. Well, and don't get me started on what do we mean by the oil market. This is the front month WTI NYMEX crude contract for 1 minute. It moves around a lot. Now, it moves around a lot more than the equities contracts, maybe because it's a more volatile thing, or maybe because it's more driven by human traders than electronic traders, or maybe the algorithms that are driving the trading in the market and the bid and the offer are less sensitive or more sensitive. I don't really know, but it's very different. That doesn't look like the equities markets. And once you look at this data a lot, you can actually sort of eyeball the data and say, that looks more like a bond contract, and there's a bond contract which does look different. Again, same minute of data, but lots of lots of volume here on the bid and offer. Literally, nearly thousands of contracts on the bid and the offer. Not very much traded though, and mostly they kind of trade at sort of about the same level. So these are all kind of different, but they're clearly not Gaussian plus a drift. Okay, so I mean, I've said this about 4,000 times today. I'll say it one more time. There is just a huge amount of this data. It's very easy to get entranced by looking at this tiny little amount of data that is the 1 second or the 10 seconds worth of data, but it's just an absolute fire hose of data that arrives every single second. Okay, so do some back of the envelope stuff because I like backs of the envelope. I think it's close to 10 trillion data points. Now, I have a big advantage where I work, that I've got access to all of these 10 trillion data points. It's just I've got no idea what to do with them. I have, just down the road here next to the station, I have a database with 10 trillion data points in it, most of which nobody's ever looked at. So I've got no idea what to do with it. Just how do I model it? How do I think about it? How do I look at two consecutive data points which have some random amount of time between them? That's the modeling issue. There's some quite basic modeling issues here. But it is a hugely rich data set, and it's much richer than the data set that you've normally been looking at. But I thought I'd do a little bit on why. I know I said I want to make some money. Who doesn't? But let's just look at how this data is used. And this is from a practitioner's point of view. There's really two ways that you deal with this kind of data. There's two things that you do in high frequency markets. You either try and make money or you try and not lose money. Okay? Seems pretty sensible. So what is making money? Making money is statistical arbitrage. Okay? It is having some model, and generally in the practitioners community that is quite a hokey model, of the markets and identifying either short-term trends or short-term mean reversion. The guys who blew up in August, the statistical quant managers who traded equities, basically were doing this kind of thing on a very high frequency. They were looking at mean reversion style effects or pairs trading broadly. So what we're trying to do is, with all of this information, we're just trying to predict where the next trade's going to be. And because the markets are now so efficient and so cheap to trade, you don't need to be able to predict very well to make money. In the foreign exchange markets, as I say up there, the commission cost of trading $1 million is $3. Less than the cost of a latte from Starbucks to trade $1 million notional of currencies. So I know that in many academic papers that I read, it says, well, we've assumed transaction costs of this, or this is excluding transaction costs, but you almost can exclude transaction costs. The actual cost of doing the transaction is pretty much nothing. The only cost, and the cost is dominated by the spread between the bid and the offer. So the spread in the foreign exchange markets are about 1 basis point. The commission cost of trading and clearing is about 0.03 of a basis point. So since we've got both the bids and the offers, we don't need to worry about transaction costs because we know that we're going to trade at the bid and we're going to trade at the offer. Okay, so you can use it you want to use it maybe for predicting where the market's going to be in the next minute, or the next 5 minutes, or the next tick. And if you can do that, and you only have to be right 55% of the time, you get to become fabulously wealthy, which of course everybody wants. Also, there's lots of interesting information here in terms of forecasting volatility. Forecasting volatility is a big deal for people because if you know that things are likely to be volatile tomorrow, then maybe you reduce your positions a little bit. And that might help a lot of people when things are melting down. Intraday volatility, calculating volatility, and I'm going to go volatility because it's not really very clear exactly what it is you're calculating when you're looking at high frequency data. But doing some hokey modeling of intraday volatility, it's a much better forecaster of volatility tomorrow than your standard Garch model. Now that's interesting. That's maybe something that we can do some work with. There is, however, a big problem in backtesting your strategies. Just because the market was 3 at 4 and you wanted to buy at 4, in that millisecond, if you offered to, or if you wanted to lift the offer and buy at 4, you can't be certain that you got done because maybe somebody else came in before you. Or maybe that was pulled and then went back in again. Testing things like this is really very difficult. And testing market making is even harder because you just don't know. You know, if the market's 3 at 4 and so I put in, you know, I'm quite happy to make a two-way market 3 at 4, I just don't know whether or not I got done at the bid or done at the offer because that was in the past. And so I don't know. I might be able to have some reasonable probability model to tell me, well, if I'm 50% of the bid and I'm at 3, then I'll probably get done at 3 if the market trades through 3, maybe. So that's one interesting way of using the high frequency data. The other way is don't lose money. Now, this is a big deal in the futures markets and the stock markets and everything else, is how do you get, you're trading, I don't know, you're a massive hedge fund, you want to trade 5,000 lots on the bund. Now, right now, the number of contracts in the bid and the offer is maybe 500. How do you trade that and minimize your execution cost? This is, well, I could just go into the market and just hoover up all of the bids, but that's going to cost me a lot of money. So maybe I want to dribble my trade out into the market at 100 lot clips, but then that's going to take time. And so if it takes time, I have some risk, and I'm maybe not going to hit what I would execute, but on average, I'm going to pay away a smaller bid offer. This is a massive deal, both in banks and in hedge funds. Lots and lots of people do it. There's extra problems here because I might have a basket of stocks to trade. I want to trade the whole lot of them and minimize my execution cost. But if I trade one over here, then if these two stocks are correlated, then my risk has gone up. And I'm sort of thinking about how to reduce a portfolio of trades to 0, making my average risk over that period as small as possible. That's a very odd kind of utility function, a very odd way of trying to optimize something. And there is an enormous amount of industry surrounding things like VWAPs, volume-weighted average price orders, TWAPs, time-weighted average price orders, icebergs. I pretend that I've got a small amount of size, and then every time I get hit on that, I put another one in. Lots and lots and lots of stuff there. And modeling those things, developing those things is one of the reasons why we use high-frequency data. Yes?
Could you say what you said about iceberg again?
Okay. An iceberg is the name comes from the fact that most of it is hidden. So if I've got a lot of oil to buy, I've got 500 lots or 1,000 lots of oil to buy. If I go into the market and say, and put my bid in the market and say, I'm buying 1,000 lots of oil, everybody else goes, whoa, okay, well, I'm going to step way back from that and just let this guy, pay up for it. So what I would do is, or what a human trader would do, is put in 50 lots and buy 50 lots, and then put in another 50 lots, another 50 lots. Now, traders are expensive and not very interesting people to deal with, so it's much better to put computers to do that. So the idea is I put in an iceberg order which says I wish to buy 1,000 lots at 95.25, and I want to show 50 lots every time I do it. So I put in 50 lots to buy at 95.25, somebody hits me at that, and then I put in another 50 lots, and then another 50 lots until I get done. And these orders can be very sophisticated. You can sort of randomize the price that you want to do it at, randomize the size, but then of course there's lots of people out there who have things called iceberg sniffers, which watch this high frequency data and see it coming in, and when you see 50 lots get traded, and then another 50 lots appears within 17 milliseconds, then you know that there's somebody out there who's 17 milliseconds away from the exchange and is being it's a horrible, sneaky business, I tell you. Okay, but there are lots of computers in the market doing some pretty hokey modeling. I don't know who it is, but there's somebody in the natural gas market who runs a market making algorithm that you can trigger at any point. I mean, you can't actually make any money out of it, but if you put in, if the market is 5 at 7 or something, and you put in a small bid, suddenly 300 lots of bids and offers appear outside your bid and offer automatically. Then when you put your bid, it disappears again, and you can do that all day long, and these things come in and out. It's like a video game, but you don't. It doesn't cost you any money. Okay. Right, now, here's the health warning, okay, when algorithms go bad. It sounds like one of those things on Sky One. This is 2 o'clock in the morning, New York time, on the 14th of January. Okay. Now, at 1 minute and 10 seconds past 2, the CME turned on the new trading for the March 2008 E-mini S&P contract. Now, there's a lot of rumors surrounding this, but it's possible that they had replaced a router in their system by a different router. For those of you who don't know what a router is, you didn't live through the 1990s. So, just after that, the market went up a little bit, and then it started to oscillate. Okay. Now this is the amount of trading that was done. This is 75,000 contracts in 10 very, very bad seconds. Okay. That, just to give you an idea, look at the prices here. That's 14.35 down to 13.95. In percentage terms, that's huge. Okay, that's 75,000 contracts, and then it dropped off the end. Now, that is just long enough for somebody to say, what the hell is happening, and hit a button. Okay, right. Now, in that time, conservatively estimated, whoever was running that algorithm, which had the sort of the oscillatory instability, who was buying and selling at higher and higher and higher prices, probably lost $150 million. Now, that is, I know it's not as much money as Jerome Kerviel lost, but trust me, somebody had a very, very, very bad day and didn't have a job at the end of it. Okay. Now, that's one of the reasons why, I mean, it's one of the reasons why this stuff is interesting, is because these kind of things happen in it, but it's also one of the reasons why it's scary. And it's why, for example, we are running high-frequency algorithms. We've been testing them for 5 months on little tiny amounts, because I don't want that to happen, because as soon as that happens, I go out of business. That instant, it's all over. So bear in mind that because it's operating at such a high frequency, lots of odd things can happen. The rumor, and I've no idea whether or not this is true, is that there was some latency between whoever's algorithm was running, and nobody's owning up to it yet, and the actual exchange system as a result of this router, which was delaying packets. And so as soon as you introduce a delay, from you probably remember from your undergraduate physics, you have the possibility of oscillatory behavior. And this is kind of like the Tacoma Narrows, right? That's what was going on there. And it was just as a result of a delay in a router. So, yeah, that's a pretty bad day for anybody. Okay, and finally, here's the summary. I'm not presenting a model, I'm just presenting the problem. Right, the problem is fascinating, it's interesting. As I say, there's trillions of data points, trillions of interesting things to look at. It's a big, big problem though, but there's lots of opportunities in it. There's lots of academic opportunities in it because there is no real intellectual framework to think about this stuff. It's not surprising because it's hard. and it's messy, and it's just not smooth and easy to deal with. It's all those gritty problems that you don't care about, like rolling futures contracts and what happens when there's a bid and the offer. But that's what causes people to avoid it as thinking about an intellectual framework. But just even trying to think of what sort of process is this? Well, it certainly isn't a Gaussian process. Very happy to talk to anybody about this that wants to talk about it, because I find it fascinating. I was going to hand out a free CD, like you get on the front of a Sunday newspaper, with lots of data on it. But unfortunately, we have some licensing issues, and it sort of belongs to the exchanges in some way, even though we collect it and do everything with it, and even though the exchanges don't sell it for very much money. So if you want access to this kind of data, drop me a line and we'll work out some way of licensing the data and giving you access to it. I think it is fascinating. I've got no idea how to deal with it. I think, in principle, some kind of machine learning thing is the only way you're going to be able to deal with this. But, that's your problem, not mine. Okay? I've got 5 minutes to answer questions, and since I go on and on and on about that, that's probably one question.
It is.
Ian.
Since you've sort of mentioned some of the problems and things you get with tick data, to begin with, one of the ones you only touched on was really when you get handed a CD of raw data, it is dirty, it is filthy.
Yep.
And especially the older stuff.
Yep.
And I guess the question, since you're addressing a lot of the stuff to statisticians, they're going to get data, they're going to say, I want to clean this, I'm going to have some algorithm to clean it. You've really got to say, what are you doing to the statistics when you're doing that?
That's a very good point. There is the story of Olsen Associates, who a Swiss company started 15 years ago, and they were collecting tick data by scraping Reuters pages using parsing programs and storing it. And they had a really bad time for a while because they cleaned the data and added artifacts to the data by cleaning it. You can't just sort of smooth things out, apply an averaging filter. You can't just say, oh well, any tick that's more than 6 ticks away from the last tick is a bad tick, because that isn't the case. Because Ben Bernanke says we're going to cut interest rates by 75 basis points, and the bond market moves 1%, 100 ticks, like that, bing. So you can't throw away data. You can't clean it. You can probably reasonably remove zeros. However, zeros are often an indicator that the market is closed due to the fact it's being limit up and limit down. You've got to be able to handle time zones. Everything has to be contemporaneous, so everything has to work on the same time zone. Particularly the data in the lower reaches of the order book is often not very good or very noisy. But the thing I would say about it, you're absolutely right about old data, and for high frequency people, pre 2000 is just nothing. I mean, it's I have data going back for a lot longer than that, but I'm not really very interested in that. I'm not too worried about older data because I'm not really sure that old data has any relevance, because prior to 2002, 2003, all the numbers were made by human beings, whereas now most of the numbers are made by computers. So I suspect that the nature of the data has changed. And also, I've got so much of it, I can afford to throw away all that old data because it's garbage. So that's okay, I'm producing enough, the world is producing enough data that we're not going to run out of data. Yeah.
The complexity in the market seems to have evolved through the accretion of lots and lots of mechanisms as there's sort of an arms race among traders and so forth. Is it possible that one could build up a more principled understanding of the market for 20 years ago than we can do today?
I think that's possible. I think that looking at pre-electronic trading tick data, it's not very good. But looking at it, it has a lot of the same characteristics. It happened a lot slower. because it was guys in red braces, on the phone saying buy, buy, sell, sell, rather than computers doing it. So it happened more slowly. And I think in some ways maybe the addition of more automated trading systems is making the market more uniform in some way, I think. The other thing, the way we've been looking a little bit at these sort of agent-based modeling approaches, using the minority game. I think that's quite a fruitful way of thinking about it, because of course, ultimately, whether the computer's running an algorithm, it's making a choice on the basis of somebody who says, I want to buy or I want to sell. So we have to understand that process, and then how that plays out over the next 10 seconds or the next minute or the next 20 milliseconds. But I think the world is changing because of that.
Do you think that when you consider really high frequency data, the market is essentially a zero-sum game? Whereas if you extend your timescale out to half a day, perhaps several days, perhaps a couple of weeks, it becomes not a zero-sum game. And that those are the timescales in which where the market, the rest of the world pays for the market over those kind of timescales. That's where all this huge amounts of money that funnel into it and maintain these computer systems comes from, are trading decisions by people who are not sitting in front of their screens. So if you're considering merely the tick data,
Yes.
this is highly adversarial. And do you notice differences in behavior
I
those timescales?
I fervently and deeply hope that markets aren't a zero-sum game, otherwise I will be working at McDonald's. I think there are clearly sources of uncorrelated excess return in the market over the day, week, month kind of time frame. I suspect that it isn't actually a zero-sum game in the very high frequency space, because what you make there is making money through adding liquidity to the market. Most banks, however much banks describe themselves as traders in the market, they're mostly making markets. And so by making a market, every time you trade, on average, you should pick up that bid-offer spread. And it is that bit that's driving the returns of banks. Obviously, somebody else is paying that away. I suppose I should say, in some sense, it is all a zero-sum game. I mean, we can't all win. Somebody's got to lose. But I think in the high-frequency space, the losers are probably the people who are attempting to do a trade, as opposed to the winners, who are probably the people making markets. But I honestly don't know. It's not something that people think about a lot. I mean, it's something I think about a lot. It's not something I've got an answer to. Beyond just the mathematical modeling of what happens at high frequency, there's very, very little, I hesitate to use the word philosophical modeling, but economic understanding of what happens at those very high frequencies. I really don't know. I have watched people on trading desks at Goldman buying and selling every day, and they make $50,000 a day, and that's what they do. And they just buy and sell and buy and sell and buy and sell. And that's the business. They're always buying at the bid and always selling at the offer, and they make that difference between it. And maybe somebody else is paying away to do that, but then why do they do that? Why do they not become market makers? Is it because they don't want to? I honestly don't know the answer to these questions, and I think understanding the dynamics of what happens and the reasons for people trading at these kind of frequencies is probably an important part of being able to model it correctly. Hi, Frank.
Hi, Ian. I had a question concerning the interaction between the agent game that's been played between adversaries and the infrastructure that has been carried over. The latencies you mentioned are longer than within country speed of light delays, but they're comparable with router delays.
Yep.
So could you envisage a circumstance where, as router delays get smaller, geographical position of your company matters, its latency from an exchange here or there?
It already does matter. For some huge amount of money, you can co-locate your machines that are doing your stock market making inside the New York Stock Exchange building, so that your latency is less than somebody else's latency. It already makes a difference. Now, some data providers add random delays. EBS, for example, there's a kind of random delay so that everybody gets the same price at the same time. And they account for the fact that some of their subscribers might be in Tokyo and some might be in London. It's not a speed of light delay, it's a router-based delay. But there's certainly, they are known as snipers, who co-locate their machines as close as possible to other people, to the machines that are making the market, and take account of the fact that, particularly in the foreign exchange market, Morgan Stanley makes a price and they get it in 5 milliseconds, and Deutsche Bank makes a price and they get it in 30 milliseconds, and they've got a 30 millisecond window where they know what the Morgan Stanley price is, and Deutsche Bank doesn't yet know that they've done, and you can make a little tip there. Nobody likes those people very much. and generally you can make quite a lot of money for about a week and a half before whoever it is on the other side just turns you off. So it's not a long-term business. However, the futures guys, because there's a single pool of liquidity, then it's about latency. Everyone's getting effectively the same numbers, but then there's the arbitrage between the two. You've got the NYMEX doing WTI, and you've got the Intercontinental Exchange, ICE, doing Brent. Those two things are kind of the same, and there's a latency. So if you see Brent go up and you've got the opportunity to hit something in the NYMEX market, then maybe you do that. It's a bit of an arms race, and it's not a long-term business plan. Ultimately, everybody's computers are going to be sort of, connected by some fiber optic backbone to everyone else's, and you're just, you've run out of things to do there. So I'm not sure it's a long-term thing to do, but I have seen, and there are people who just make money doing that kind of thing. So
there are other long-term advantages about being close. It's more robust, for example, in terms of the whole thing staying up.
There's that, but then there's the.
It'll probably go away with technology in time.
No, but the problem with not having your machines in your own building is when that happens, you're dead. Right? I mean, somebody switched that off. You want to be close enough to pull the power plug out. It really is. It's it's like HAL or something. But faster and more scary. Okay. All right. Sorry. Okay. Thank you.